Do you remember where you left reality? I think it was somewhere around the 1970s. We're way too far to go back and try to sort it all out. Even the slightest mistake can send a shockwave throughout the world that will destroy the financial system. Weakness and fragility is present, and it doesn't take a genius to see why most asset classes have been this way throughout 2018. You came here for the truth, so let me unveil that for you. Today we're going to look at what's going on in China. I want to talk about the US, I want to talk about Asia. Let's begin by taking a look very simply at a few statistics that are coming up. One being the Shanghai Composite. Now this right here, I have shown you over the last little while has not been performing that well. The 1 month is down. We look over the 6 month, it's down. And it is technically, I believe, I didn't make the calculation today, but technically still in a bear market. If not, it's just shy of that. It was around 22% down from its peak. So that is very, very worrisome. Now, all of this issue with trade going back and forth, that has presented itself to become sort of forefront on these different topics that are going on all around the world today. Speaking of that, Tesla and BMW AG are among the biggest potential losers from Beijing's retaliatory tariffs on car imports from the US because much of their production is centered in America. They're now doubling down in China. This week, Tesla announced its first factory outside of the US, while BMW is poised to become the first foreign manufacturer to own majority control of a Chinese automobile venture. Cars made locally by foreign brands will dodge import levies. We got something going on today, and these big corporations have ways around everything. Even, I'm reminded of what happened during the financial crisis. We had these big car companies that were suffering. They got bailouts, and then they decided to use that bailout money to open up factories in China, in Brazil. Why? Because it's more profitable, and that's all they care about. They don't care about jobs. They don't care about anything. They'll figure out a way to make the most money. If it's going to be positive for them to open up a factory in China, in Brazil, or anywhere else, they will do it. They don't care about any sort of loyalty or anything. All right, it gets into a little bit more of these details, but I'd like to move on, talk about this. China reported Friday that its June imports rose 14% in dollar-denominated terms, falling far short of a 20% increase expected by an analyst. China's exports, meanwhile, slightly topped expectations by rising 11%, according to data from the country's own statistics. So China had a $41 billion trade surplus in June, and that is big. That is becoming a very big problem because it just keeps widening and widening over a long period of time when you look at it. I would say that China is in a very tough position because this is one country that is required to grow persistently every single year for the foreseeable future. Anytime there's a slowdown, there's a lot of talk about this is going to be the end of the world kind of business because so much is relying on China. They consume so many commodities, whether it's agriculture or whether it is industrial type commodities. They're buying a whole lot of gold as well. Everybody is sort of globally relying on China to be that consumer, and it just doesn't work like that. They're also relying on more and more people every day to move from the rural areas into the cities, which is happening, but it needs to quicken that pace in order to keep up with it. And this is not a good thing because that has to happen at some point. You need to have slowdowns. It's okay. So, to answer the question, is China in a recession? Well, their stock market, the Shanghai Composite, is in a bear market. We can see that they are hurting in some ways. I wouldn't call it a full-blown recession because they've instituted stimulus measures, and they have the largest public works projects that have ever been seen in history. Ultimately, China has a very big hurdle to overcome here in the near term. So let's look at this. Canadian soybean farmers find themselves in the crossfire of the escalating US-China trade tensions. So you can see that soybean prices have plunged about 20% since April, when China first announced the 25% tariffs on US soybeans. And of course, it goes on to talk about more details. This has been an issue because it's going back and forth and back and forth. Some people say it's good. Some people argue the other side of it. I would say that we have big issues ahead of ourselves. Doesn't really matter. We're going to find out the details of all of this in the, I would say, midterm, because what I would like to focus on here is not the short-term noise, but I want to know how this has a dramatic effect to the, not just the markets, but the actual real true economy. And that here is, as far as I'm concerned, not going to be revealing itself in the short term. The stock markets will trade it in ways that are really nonsensical sometimes. Investors have never been so bearish on Asia bonds, study shows. Asian bonds investors reduced positions in June to the most underweight levels ever for the regional asset class, stretching back to 2009. So we've got an issue right now that brings us back into that timeline, and it is worrisome, not just for those investors, but what does that signal? Topping 10%. Chinese and Asian junk bond indexes hit multi-year highs as defaults spook. So you'll see that on the chart here. Chinese corporate dollar junk yield, Asia corporate dollar junk yield as well, both rising to levels that we have not seen for quite some time. Investors see China's liquidity tightening and domestic bond defaults as the top two risks for the Asian credit market, followed by fund outflows. Always keep an eye on the outflows. We need to know where money's coming in and out. A lot of times it actually doesn't make sense because there could be a massive outflow in the day in the US, for example, and stocks rise. So sometimes it's a little curious what's happening and who's manipulating behind the scenes, but it's not so black and white. They cut Asian bond holdings to 24% net underweight in June from negative 13% in March as they raise cash levels and reduce risks. They see what's happening with the trade issues, they're uncertain, and so they're making some changes. This has been going on for a little while, but it has been heating up in the recent weeks. Attractive differentiation. Yields on Asian junk bonds higher than their US peers. So the blue line right here is the yields on the Asian high yields right here, and the US being significantly lower. This is about 9%, and this is about 6.5%. So definitely a big difference in between the two. And investors may decide that when the time comes and they want to take a little bit more risk, that they may choose that. You can look at areas of Europe that, despite the fact that they should be giving out some higher yields, that they're not. We've got a big mess going on in Europe. Everything's out of whack because the ECB is buying it all up. Then we turn the pages over to our friend, the insider, Warren Buffett. Warren Buffett is beginning to say farewell to his equity derivatives. Right. Once he referred to them as financial weapons of mass destruction. You may have heard that quote before. But he did some purchasing. Equity index put options written by Berkshire Hathaway started expiring in June, and the last of them will be gone in 2026. Buffett, Berkshire's chairman and CEO, initiated the deals between 2004-2008 to bet that the stock prices would rise in the long run. The options tied to 4 major equity indexes added a total of $2 billion to earnings during this time frame. So it's interesting to see a person like Warren Buffett getting into this. I mean, it's not a big purchase compared to the whole size of the company, but it is interesting because he referred to them at one point as, you know, being so controversial, so dangerous, and yet bought into that. Well, here Buffett already ended some other derivative bets, exiting his last credit default agreement in 2016. And it goes on to talk about this, how he said they were not, didn't have any counterparty risk. It's different, but we've heard that. statement before. Who knows? Either way, I just thought it would be important to discuss that with you. I usually like to pay attention to what Buffett does because not necessarily would want to trade like him. However, people are watching him, so I'm watching what he does. Quickly, U.S. Commerce Secretary Wilbur Ross said in a statement that he would be selling all of his equity holdings and buying Treasury securities with the proceeds after receiving a letter from the U.S. government Office of the Government Ethics saying that Ross run afoul of the primary criminal conflict of interest law. He's basically going in saying, I got to do this. He's being forced to, so he's selling off the stocks. He's buying treasuries instead. Does he know something ahead of all this? I don't know. I don't think so. Necessarily. I'm sure he's in the know more than you and I. However, this right here, definitely not a good investment, but he's sort of forced into it. Now, one emerging economy I wanted to discuss here, I know I have some subscribers from Turkey. I will bring this information as I can with any country. I'm always looking for different pieces of intel all over the world. Investors dumped the Turkish lira as they turn cold on emerging markets. So we can see what has happened with the currency over the last little while. I mean, we're looking at since the 90s, it fell down, but in more recent years, since the financial crisis, it has just been going off a cliff, as you can see here. It is consistently losing value as time goes on. This right here shows us more specifically over the last few days. In fact, this is only up until the 11th trading day. However, just looking at the actions that they've taken, and yet it still goes down further. People don't understand that, how we're taking measures, whether we're using some of our reserves, whether we are doing this or that, and the value goes down. Well, of course, because of what you're doing. It actually makes it worse. The more intervention there is, the worse it gets. And here, last but not least, just wanted to touch on this, the fact that we have yield curves that are starting to show us that we are heading back into the time frame of 2008, 2000, and so on. So you can see the yield curve. If you were to search that up, you'd be able to get some of these technical analysts that are out there and could explain that for you top to bottom. But all I know is that when I see this, I see the patterns, I recognize it, I see the history, and then I make my educated guesses based on that. It doesn't necessarily mean that this inverts, that we are going to have a crash tomorrow, but it is one of the major indicators that traders are watching, that algos are watching as well, the algorithms, computer algorithms. So that's all. I'm going to end it there. I hope you found this video informative. If you did, then please give me a thumbs up. When you give me a thumbs up, it helps to support the channel, so I do appreciate that very much. And last but not least, if you found the video informative, I know that you'll find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. If you're interested in these books, all you have to do is go to the link in the description. It'll take you to Amazon. You can flip through the books for yourself. If you're more interested in the audiobook version, you can get that at themoneygps.com.